Welcome to On My Way to Wealth, the podcast where busy Gen Xers can learn financial tips as they navigate life on their way to wealth. And now, please join your host, Luis Rosa.
This episode is brought to you by Latin Excellence. Visit latinexcellence.com. That's Latinx, CELLENCE.com or latinxmovement.com to learn more and shop our merchandise. You are excellence. Hello, welcome to another episode of On My Way to Wealth. My name is Luis and I'm your host. Thank you all for tuning in. Often as a financial advisor, I work with my clients to help them determine if they need life insurance, and if so, what type of life insurance is best for their needs. Although I do not sell life insurance, it's still part of the overall financial planning process, evaluating risk and figuring out the best way to cover those risks. So today I want to talk to you about the difference between term life, whole life, and which one is better depending on your circumstances. Most people that either have children or mortgage are probably going to need some life insurance because life insurance is usually bought in order to replace income. So if you have, for example, a couple and you have a home together and you have children, a lot of the times one salary may not be enough to cover those expenses. So it's usually a good idea for both to get life insurance so that if in the unforeseen circumstances, one of them passes away, the other one can still carry on and continue to pay the mortgage, do things like pay for the kids' colleges, things of that sort. So it's very important that you take a look at your life insurance needs. I did an episode talking about whether it makes sense to buy your own policy or if you should have the one that your employer provides. So be sure to tune into that one as well, because I go a little bit into more detail as far as when that makes sense. But in this episode, I want to talk about the difference between term life insurance and whole life and which one's best under what circumstances. Term life insurance is the simplest method of insurance that you can purchase. It's also the cheapest. As the name implies, you buy the insurance policy for a specific term. For example, the most common ones are usually 10 years, 15 years, 20 or 30. So you basically say you can go online or speak with your insurance broker. They run a quote. They're going to ask you questions about your health. Some companies do not require a health exam up to certain limits. So be sure to ask about that. A lot of companies do. So depending on the coverage that you're looking for. But for the most part, they still are going to ask you some sort of health questions, like if you smoke, if you are engaged in any risky activities like flying planes or paragliding, because it all comes down to risk and probability of you dying ultimately. For the most part, if a male and female, for example, are looking for a policy, usually statistically, it's better. Everything being equal, usually policies for women are lower. So just keep that in mind. So that's one of the advantages for sure that women have. You always see like their policies tend to be cheaper, which is great. But the term life insurance, a lot of people are hesitant to buy some because they feel like, hey, if I survive the term, then I just wasted money, because if you buy a policy, say for 20 years, and then you've been paying your premiums every month or every year for 20 years, and then 20 years later, you're still alive, the policy ends. There's no benefit at all. There's no payout. And you're going to feel like, wow, I just lost all that money, right? So I completely understand that. Look at it from a sense of, well, I paid for peace of mind. Think about how you buy car insurance. If you don't get into an accident, you're really not using it, right? Most of us are probably just spending money every single month buying auto insurance. And we don't really get any benefit from it, but it's there in the event that you are, in fact, in an accident one day, or you get sued if you were found liable because you caused an accident or something. So it's there, that peace of mind, because it also helps you protect your other assets. The only difference is that car insurance is mandated, right? So that's why most of us have it. So think of it that way, right? You buy term insurance for the purpose of replacing your income, and it's usually for a given amount of time. So to give you an example, let's say I do a lot of work with couples. They may have just had a baby. So a lot of them say, you know what? We just want to have enough money to cover the expenses while our child still lives with us, right? And they still depend on us financially. So a 20 or a 30-year policy may do just that because you have enough coverage until your child is 30. By then, you may no longer need that insurance anymore because they already graduated college, maybe they already got married, left the house, and you no longer need to support them, right? So a term policy will be perfect under that scenario. It covers that crucial period of time. A lot of people also use it to cover other expenses. For example, like, okay, if I die, I want my spouse to have enough money to continue to pay the mortgage or pay the mortgage off or have enough to pay for our kids' college or something like that, right? So under that scenario, it's best to just have the cheapest possible insurance, which would be term. Now, there is a product. It's not that often mentioned, but I've seen it. It's called return of premium. It's also a term insurance policy, but you actually get all of your premium money back later when the term ends. Obviously, that's going to be more expensive because the insurance company is going to return you your money at the end of the term, but it will be more expensive. But some people opt in for that because they say, you know what, if in 20, 30 years I'm still alive, then at least I get all my money back that I paid into the policy, right? So, but you ended up paying a lot more than you would have had you just bought a straight term insurance policy. So those are the kinds of things that you definitely want to look at, consider, and see what may make sense for you. Now, let's talk about whole life insurance policy. Whole life is, again, also as the name alludes to, you buy insurance coverage for your whole life. So the policy will technically pay out at some point, regardless of when you die. So if you live to 99, somebody's going to get that money, whoever your beneficiary is or your estate, right? So they serve a purpose, right? So if you want coverage for a longer term, no pun intended, then you will buy whole life insurance. So I'm going to give you some scenarios when that makes sense as well, because whole life insurance is a lot more expensive. I mean, by far, like when you compare the same amount of coverage from a term policy to a whole life, I mean, the premium could be 20 times higher. And I'm going to give you some numbers that I saw online so that you can use it as reference. But let me give you some just basic parameters of how whole life works. So number one, when you're paying for the insurance premiums, you're actually paying for more than just insurance. The policy has a cash value feature. So part of the money that you're paying actually goes into a cash account within the policy that over time grows because you also get a guaranteed rate. And a lot of whole life insurance policies also, they're considered, they call them participating policies. And all that means is that you also get dividends based on how the company performs. So those dividends can also be used to boost your policy's cash value. So in essence, you have two components to it. You have your death benefit, and you also have a cash value that also grows over time. And a lot of people are interested in these types of policies because later on, they use the cash value to borrow from it. And you can borrow from your cash value tax-free. So that can be an advantage. If you have a whole life policy and you have $200,000 in there, later on, you can technically take a loan against your policy tax-free and use that money to start a business, pay for college, or whatever the case might be. But you have to consider the fact that you are paying significantly higher premiums. So it's not really for everybody, right? If you're looking for the cheapest cost and you just want to be covered for a certain amount of time, then term policies are going to be your best shot. If you want to use whole life policy, let me give you a few scenarios. For example, there are some that I can think of where it makes sense to have a whole life policy. So one of them, let's say you are a business owner and you have a partner. A lot of people buy whole life policies as part of their buyout agreement with their partners, because if one of them dies, they basically buy policies to insure each other. That way, if one of them dies, the person that's alive and receive the death benefit can then use that to buy the other portion of the business from the person that passed away, right, from their estate. So that's one option where you would use a whole life policy. Another one is, say you have children or a dependent with disabilities. And, you're concerned, obviously, that if something happened to you, you want them to be well taken care of. Then you can buy a life insurance policy like a whole life that that at some point it'll pay out. And then you can have that policy pay, say, a trust, for example. And that trust can be set up to continue to provide for your child after you're gone. So that could be another reason why you would use a whole life policy. And also, it could be another method for you to just accumulate part of that guaranteed cash value. So when people are attracted to a whole life policy because of the cash value feature of it, I always tell them to consider if, first of all, can you afford the premiums? Number two, have you already exhausted every other pre-tax saving option that you could? And for example, are you already maxing out your 401k? Are you maxing out your health savings account? Are you maxing out your, say, your individual retirement account, right? If the answer is yes, and you could afford to save above and beyond maxing out all of your pre-tax options, then this could be potentially another way where you can buy a policy, put more money away, and eventually build long-term on that cash value, and then use that cash value tax-free later as a strategy. And that could be a very good option for you. But I would always recommend make sure you can clear certain hurdles first, like being able to afford it and that you're already maxing out your pre-tax options anyway. So if you have a business partner, if you have a child with disabilities, or you just want to leave money for your heirs, regardless of when you die, the whole life policy could make sense. On the other hand, if you're looking for, hey, I just want coverage for a certain amount of time until my kids are X years old or whatever, right? Or until I retire or whatever it is, then just buy a term policy. Now, let me show you an example of a difference in premiums. I was looking at an article from NerdWallet, that's nerdwallet.com. And they showed an example of a quote that they got from a company just to compare. So I'm going to show you just male and female for 20 and 30 year term and also a whole life. So to give you an example, this is assuming that you're 100% healthy, no health issues. So a healthy male, age 30, a 20-year policy was $229 per year for $500,000. This is all of them $500,000, $229 a year. Not really that expensive, right? A 30-year policy for $500,000 is $358 a year. Now, a whole life policy for the same amount of $500,000 is $4,308 a year. So this is way more than the term policy. So I wanted to show you that just so that you see that the drastic difference in premium amounts. Now let's look at female, same thing, 20-year term. Remember I was saying how females are usually lower. So the male 30 was $229 for 20 years for $500,000. Female age 30 was $193 for 20 years for $500,000. A 30-year term life is $358 for a male age 30 for $500,000. A female is $300 a year for the same $500,000 for 30 years. Now, the whole life policy for the females, $3,802. So you see it's the same principles, like it's exponentially more money, right? So there's a term in our industry that says buy term and invest the difference. And what that means is, let's say you compare, in the case of a 30-year-old male $500,000 policy, if you were to buy a policy that's term, it's only $358. You can say, you know what? If I bought a whole life, my premium would have been $4,308 compared to $358. So that's $3,950 more that the whole life policy costs, right? So if you buy the term policy and then you invest that $3,950, for example, and let's say you do that for 30 years, and let's just say you average 8% rate of return over 30 years. Say you put it in the stock market, right? That amount of money would grow to about $487,000, which, if you think about it, is almost just as much as the death benefit would have been, right? So in essence, you can buy a 30-year policy, which is the cheapest, invest the difference, and in 30 years, you have just as much in your investment as the $500,000 coverage that you would have had anyway, right? So that's another way of looking at it, where you can say, you know what, I'm going to self-insure. I'm just going to buy term and invest the difference, as opposed to buying the whole life, right? So that's another thing that you can use, so when you're considering whether to buy term or whole life, just think about what your goals are. Am I looking to do this for just a specific period of time? And if so, maybe a 30-year policy does the trick, because maybe in 30 years, right, your kids will be grown, your mortgage will be paid off, and maybe you don't need insurance anymore, because in those 30 years, you grew your other assets, the equity in your house, you grew your 401ks, you grew your investments, right? And you could just invest the difference that you would have paid to a whole life policy, right? So obviously, one is not better than the other as a straight question. It depends on your circumstances and what your goals are. which is I always recommend that you speak to a financial planner before you purchase any product, just because everybody's situation is so different. And a lot of the times, some people end up with the wrong type of policy and overpaying for insurance that they didn't necessarily need. Sometimes the cheapest 30-year policy or 20-year might just do the trick, right? So, I think I just laid out the differences and when it's best for you to buy them without getting too technical. So hopefully you find this useful. As always, if you have any questions, send me an email, luis@onmywaytowealth.com. Thank you for tuning in, and I'll see you in the next episode. Thank you for listening to On My Way to Wealth. If you have any questions, please send me an email at luis@onmywaytowealth.com. The information provided here is for information and education purposes only. The opinions expressed herein are solely those of myself, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by my firm or myself about other parties' information or accuracy or completeness. All information or ideas provided should be discussed in detail with a financial advisor, accountant, or legal counsel prior to implementation. Thank you.